Next up, we have Wade Hutchings from Enerplus. Enerplus trades under the ticker symbol ERF on the Toronto Stock Exchange and on ERF on the New York Stock Exchange. Hi, Wade. Wade is a senior VP and COO and welcome today.
Thanks, Jess, for the invite, and we really appreciate all the participants for your time and for your interest in Enerplus today. So just our customary forward-looking material. Today, we think of the company as strategically having one single core asset, and that's the Bakken. The Bakken, in our mind, is a differentiated position within the basin. We see ourselves as having the most remaining Tier 1 drilling inventory among similar-sized companies. In fact, that inventory represents well over a decade of inventory. We have a long track record of capital discipline and returning capital to shareholders. In fact, the company has returned over 60% of free cash flow to shareholders through both dividends and buybacks since 2017. We also have a long track record of operating with low leverage, with the last 5 years having been at or below 1x net debt to funds flow. We remain well positioned to continue this track record, and given the strength of our inventory and the continued prudent approach to managing through price cycles. So let me turn now and just give you a couple of highlights from our recent Q1 earnings release. So the key thing we announced last week was a increased return of capital to shareholders framework for this current year, where we committed to returning a minimum of $350 million or 50% of free cash flow, whichever was greater. We expect to generate over $675 million in free cash flow based on $85 WTI and $5 NYMEX. Of course, strip is higher today. We increased our annual production guidance based on strong execution and the ability to optimize our forward development plan. We also talked about how we were managing the inflationary environment and noted that the actions we took in 2021 to secure crews and equipment and services for this year continues to protect us against what we're seeing out in the market. We also have started the year out really well from an execution perspective with our rig and frac crews that we've been using for quite some time. And then lastly, we noted that our intention was to continue to maintain capital discipline and that we had no plans to chase further growth as we see that would come at less efficient capital. Moving on to a summary of our 2022 plan, what you can see here is a capital plan in the range of $400 to $450 million. This is based on a 1.5 rig program, which is designed to deliver low single-digit organic production growth, represents a reinvestment rate of just under 40%. The plan is expected to deliver robust free cash flow and significant year-over-year free cash flow growth. The chart on the right is showing our 2022 free cash flow yield at different oil prices. And you can see that based on our current valuation, our free cash flow yield is north of 20% based on oil prices above $80 WTI. Let me shift now to a little bit of detail on our 2022 capital allocation plan. You can see here that $85 WTI, we expect around $1.1 billion in cash flow, less our CapEx plans and the $40 million annual dividend leaves just under $650 million of excess free cash flow. Today, we plan to prioritize share buybacks and debt reduction with this excess free cash flow. And if you recall, we made a commitment at the quarter where we would commit to at least $350 million or 50% of the free cash flow returned in the form of dividends or share repurchases. Let me give you a little bit more detail to that return of capital commitment. What you can see here is that if you look beyond the $40 million annual dividend that we just announced, we plan to return a minimum of $310 million to shareholders this year. As we've noted today, we're prioritizing buybacks as the principal return mechanism, given the disconnect that we continue to see in our share price compared to the intrinsic value of the company. And we base that intrinsic value on what we view as mid-cycle prices. Now, the chart on the right shows the total return of capital at different oil price decks. Effectively, at prices above $85 WTI, will return more than the $350 million minimum commitment. You can see at $95, that would be $370 million. That kind of capital return represents greater than 10% total cash return yield, dividends plus buybacks, based on our current market cap. Now, if our shares reach a valuation that doesn't justify buybacks, we will return the committed capital to shareholders via another dividend mechanism. Let me now shift to how the business looks over the longer term. So we've provided this 5-year view that's focused on generating sustainable free cash flow. The plan is very much levered and focused on the Bakken, where we see the vast majority of investment and the vast majority of cash flow generation. The annual capital of $400 to $450 million is expected to continue to drive a 3 to 5% production growth and generate $2.3 billion of cumulative free cash flow. Now, a key point here is that this plan is based on a $70 WTI price environment. So in a higher price environment, we would expect some inflationary pressure on the capital spending, but this would be more than offset by the higher cash flows. So even in this $70 WTI environment shown here, we would expect to free cash flow at least 3/4 of our market cap in that 5-year window. Now, let me make a few comments on our approach to good governance and safe, environmentally sound operations before I dive into some more details on the Bakken asset. So we're now at a spot where we have deeply integrated ESG strategy within our operations with strong board oversight. We've identified 6 material focus areas that we believe will reduce risk and support long-term business resilience. You can see that those 6 areas on the image to the right. Now, a few highlights from 2020-21 performance. We reduced our GHG emissions intensity by 25%, and we continue to work towards our longer-term target of a 50% reduction by at least 2030. We also had great success reducing methane intensity. We had set a 2-year target to reduce it by at least 20%, and we were able to achieve that and more in the first year. We also have continued to find ways to integrate the use of produced water in our fracture stimulation program. And by doing that, we've reduced our freshwater use by 31% last year. And then lastly, we're very proud of the exceptional safety performance we had last year, where we operated the entire year without any lost time injuries. So integrating these kind of actions throughout the company and our operating practices are not only continuing to deepen our ESG performance, but we're actually continuing to find that they're driving further efficiencies to costs, cycle times, and other key operating metrics as well. Let me shift now and dive into some more details around our specific Bakken position, but let me start out with a comment or two about the Bakken in general. So if you look at this chart of break-even levels for different plays in the U.S., you can see how the Bakken stacks up. Now, we believe that the Bakken has and can get overlooked a bit by investors due to it being one of the more mature shale oil plays in North America. Some have even said, the inventory in the Bakken is almost all played out. And I'm here to note and tell you that's simply not the case. It's not correct. We actually think that the Bakken continues to have several structural advantages that makes it an attractive investment in oil and gas. So the first is that there actually does remain a fairly substantial drilling inventory in the basin. Based on our own analysis and external third-party analysis, we see well over 10,000 drilling locations that remain viable at or below $60 WTI break-evens, representing close to 15 years of additional drilling at today's activity. Now, importantly, the core of the Bakken, which is where virtually all of the Enerplus inventory is, as you can see on this chart, competes with the best oil plays in North America. The break-even chart highlights the core of the Bakken, represented by those two yellow bars for Little Knife and FBIR, or Fort Berthold Indian Reservation. That's where 85% of our next 10 years of inventory sits. Now, in addition to this long runway in the basin, the Bakken also benefits from one of the most supportive regulatory frameworks in the country. And lastly, the basin has significant takeaway infrastructure, which supports a strong oil price realization forecast for the future. Let me shift and give you a few more bits of detail and color around the Enerplus inventory. So as you zoom into our position, you can see that we are representing over a decade of core drilling inventory. That's shown in the dark gold on that bar chart. And that inventory is what supports not only our 5-year growth plans that we've talked about, but really supports a decade of growth that we see in front of us right in the core of the play. Now, the core of the play is what we consider to be the best subsurface conditions to drive great well performance. And it's an area that's very well established, it's very defined, it's de-risked. And for Enerplus, it represents our FBIR, Northern Dunn, and Eastern Williams County areas. Now, on top of that decade of core inventory, we see another couple of years of inventory that we would call extended core. Naturally, this is an area that sits just right outside the periphery of the core, and they have slightly lower returns than the core. But at today's view of mid-cycle prices, that inventory would exceed our return threshold, and we would certainly see it being developed over the longer term. And then lastly, beyond that, shown in the gray on the bar chart, we have several more years of upside locations, which we view as offering potential if we either remain in a higher commodity price environment, or if we can continue our track record of improvement of well costs and well performance through efficiencies and technology application. Next, let me shift to a little bit of data that supports what we view as a high quality differentiation between the Enerplus inventory and the inventory that sits there in the average peer in the basin. So this chart shows quite a bit of data. And so let me just describe a little bit of it for you. So if you look on the left axis, you'll see remaining net locations. And then the stacked bar charts for each of the companies listed is broken out by quality. And it starts at sub 45 WTI. You can see that we've ranked the chart on sub 50 quality. That's the dark green level. And this third-party data that we're showing here at a basic level simply shows that Enerplus ranks third in terms of having that high-quality core inventory remaining in the basin. But we want to go a little bit beyond just that basic ranking. So if you look at the right axis on the chart, it shows in-basin production. And then if you look along the top of the graph, you'll see that we've also divided each of the companies by market cap, with the dark blue representing greater than 10 billion market cap and the light blue under 10 billion market cap. So importantly, when we look at the inventory now compared to market cap or in-basin production, you can see that Enerplus's inventory stands out even more, hence the differentiated position that we've talked about. So you can see there, among smaller cap producers, Enerplus has the most core high return drilling inventory left in the basin. So one broader way to frame that is, based on this data, we have 12% of the remaining sub 50 inventory versus only having about 5% of in-basin production. Now, before I wrap up the comments and turn to some questions, I want to illustrate some of the assumptions behind our view that basin egress is very supportive of a constructive forward oil price realization. So on this chart, what we're doing is framing the oil takeaway versus what we see as future oil production in the basin. So as you can see in the chart, historically, the Bakken has dealt with a relatively wide oil price differential, which was initially driven by insufficient pipeline takeaway. That dynamic began to change significantly when DAPL came online in 2017, as you can see on the chart. Clearly right there in that early 2017 period, a lot of additional capacity was created by DAPL. And you can see the resultant impact on differentials up above that in those gold bars. Now, since DAPL, you can see that prices improved markedly. The last few years, the oil price realizations have sat there in, call it the $2 to $3 range, outside of what was a bit of an anomalous differential world in 2020. Now, today, we're dealing with an even more constructive outlook, given the significant spare pipeline capacity in the basin. So if you zoom into the chart, you can see the additional approved DAPL capacity that came online in late 2021 and the 400,000 plus spare basin capacity that created. So if you look into the future, you can see how the internal Enerplus volume forecasts look, and those are based on either a 30 or a 50 rig case. And you can see how that also compares with a recent WoodMac view of forward production. So all of those scenarios paint a fairly clear picture of continued excess egress out of the basin. So based on all of that, we now expect our 2022 realized oil prices to be at par with WTI. And we continue to expect tight pricing between par and -2 over the longer term. So let me just make a few wrap-up comments here. So again, for the Bakken as a play, the Williston Basin as an area of focus, we continue to see that as an attractive oil and gas investment, not only for ourselves, but for investors as well. Specific to Enerplus, we have a very high quality 10-year plus runway of inventory that's going to continue to drive volume growth and, more importantly, cash flow growth. We have an operational mode that continues to leverage environmental, safety, and good governance right into our operating model. We're trading at a very attractive free cash flow yield today. We are committed to maintaining low leverage and a strong balance sheet. At the end of the quarter, we were at 0.7x net debt to funds flow. We maintain our commitment to shareholder returns, and we've now deepened that with our recent announcement of returning 50% of free cash flow this year, or a minimum of $350 million to investors via dividends and share buybacks. And we continue to see a long-term view that's supportive of our ability to continue this model. So thanks again for your attention, and happy to take a few questions.
Thanks, Wade. That was a very good summary. If we can start just back to the Bakken and your quality of locations there, how many wells per section have you guys drilled compared to some of the others that blew themselves up in historical times and overcapitalized?
Yeah, good question. The basin has actually saw companies, if you want to be neutral in the comments, companies have tested a lot of things over time. And really, Enerplus's direction was quite different than many peers. It started out at lower spacing and now has gotten to a spot where in Fort Berthold, we're very comfortable with our spacing model. Whereas other companies may have tested the upper bounds and really, in some cases, clearly overcapitalized some units. So in the core of the play, we actually see the ideal spacing model to be approximately 10 wells per unit. In the core of the play, both the Bakken and the Three Forks work. So we typically are seeing 6 Middle Bakken wells and 4 Three Forks wells as kind of the standard template. Now, as we go forward, we custom design every unit based on offsets, et cetera. But that would be our standard. we think that development model applies as you move into northern Dunn County. In fact, we see that area as being very comparable in quality to the legacy assets we've had in Fort Berthold. When you get beyond that in our portfolio, we're mostly looking at developing the middle Bakken, and there that spacing model would range generally 5 to 6 middle Bakken wells per unit. But I think one of the exciting things for us is we're going to continue to see where we can extend Three Forks development, particularly in Dunn County.
Okay, so you've got a lot to do, and do your completion techniques vary from area to area, or have you been do you think you've pretty much standardized them?
Well, again, prior to the 2 transformative acquisitions we made last year, we had gotten into a fairly repeatable cadence. If you looked at our well performance in the core of the play, the well performance literally was tracking on top of itself year over year, despite the fact that we were becoming more and more weighted to development wells and infill wells. So, relative to a lot of plays, it's a good track record of consistent well performance. In that, the completion design evolved, but I would say the last couple of years had stayed pretty steady in our recipe. Mm-hmm. Now, as we think about the new areas we've acquired, there clearly is a case for differentiating that stimulation design. For instance, in Williams County, if you just look at the historical designs, it looks a little bit different than what we've been doing in Fort Berthold. And so we actually see a need to continue to test that to find not only the ideal completion design, but we'll also be doing some work to find the ideal infill density as well. And then when you move into Dunn County, what's interesting to that position we picked up was we literally had not saw a new completion on the acreage we bought for 5 to 6 years. And so kind of the completion design and even the well performance on the units we bought is helpful, but it's not really relevant to today's stimulation design. Now, fortunately,
it'd be pretty dated, right?
It would. Yeah. And we knew that and we factored that in as we evaluated that, tried to predict future well performance. Fortunately, in a lot of that northern Dunn County area, there's been fairly significant industry activity from some of the biggest operators in the basin. And so we have a lot of adjacent and relevant analogs of both infill density design, completion design, and well performance from those operators. And so that also gave us a lot of confidence that the acreage we were buying had a lot of upside potential beyond what it had demonstrated. I think in northern Dunn County, you'll see for us probably a similar completion design. But as you move further south, and we have an area in southwest Dunn County we call Murphy Creek that we're actually quite keen to apply modern stimulation practices to. There just hasn't been a lot of activity there. So we'll test a few different things as we develop some of the new acreage we have.
And we'll start to see that this year?
A little bit this year and then a lot next year. One of the pads we're bringing on this year came from our Bruin acquisition, but that's in the core of the play.
Yeah.
We are beginning to drill wells in that Dunn County area. And so you'll see wells come online from that, certainly at least by next year.
That's super. Now, to bring up a bad topic, I mean, DAPL, any chatter again that they're thinking of shutting it down? I haven't heard anything in the last year, but...
We have not. Relative to the types of questions we were getting last year or even what was going on externally, it's very quiet today. There's a couple of very positive signs. One is middle of last year, DAPL actually expanded by 180,000 barrels a day. So that was approved and it expanded and it's now operational. Of course, the pipe has continued to be fully operational during this whole period. So, there still remains one last milestone, and that full EIS is currently still in progress. I think right now we're expecting the output of that in the fall of this year. But our view is that the risk that we were carrying before, or that even the industry was carrying before, is significantly less than it was. Frankly, would see it as a very surprising thing for anything to negatively come out of that review.
That's good. I couldn't believe when they thought they were going to drain it all. The stupidest shit's going on. These people on the A&D side. I mean, obviously you've done your 2 acquisitions last year. You have your Canadian assets up for sale. With the volatility in oil and gas prices, has it been tough to kind of strike a deal on those? And also, what do you see on the acquisition side in the Bakken, if anything?
Yeah, maybe let me make a few high-level comments, and I'll try to answer your specific questions. The A&D markets today are very different than they were coming into last year when we struck those 2 deals. And clearly now the timing of those 2 deals was ideal. And we had a sense for that. I mean, we had kept our balance sheet in great shape, and we were in a spot to be opportunistic when the market began to turn. And so clearly when we did the 2 deals last year, it felt a bit like a buyer's market. Not that it was low risk or no risk, but those we were quite pleased to find those opportunities and add them to the portfolio. And as last year progressed, and as we come into this year, we're just in a very different market. I think today, if you are going to be a buyer in the market, so to your question of further A&D or acquisition work by us in the Bakken, we continue to look at almost every deal that is available, and even ones that aren't available. But today, I think you have to be a very careful buyer. When oil's at or above $100 and you've got some of the volatility out there, we are very focused on value. And so, despite our equity, recovering considerably over the last year, we still see a very compelling value in buying our own shares. And so any kind of opportunity for us to acquire more Bakken inventory or volumes has to be weighed against that kind of opportunity in our own shares in obviously a company we know really well. On the flip side, you mentioned that we do have our Canadian assets actively in the market. That process is on track, proceeding as we would have thought, and we generally would still expect updates in the summer for the market. Given the constructive market, we're actually, we would generally be pleased to sell in to today's market. With that said, we're going to be quite disciplined about value, though. These assets that we have in Canada, or even our other non-core assets in Pennsylvania and the Marcellus, at today's prices are generating significant free cash flow. And
you love that gas in the Marcellus. It's only non-op 10%. Yeah,
that's fantastic.
Yeah,
it is. And so, for us to be a seller of any of those assets, specifically the ones we have in the market in Canada, we're going to need to see good, strong, fair value, because our alternative is we simply continue to operate those and clip a really nice coupon.
Oh, for sure. We've run out of time. I have more questions. Maybe I'll have to give you a call after.
Sure.
I don't think there's anything from the audience I missed, but I do have some. I'll give you guys a call maybe tomorrow, and you and Drew, and we can do a few add-on questions if you don't mind.
Happy to.
Really appreciate your time, and great story. So keep doing what you're doing. That's okay. I'm a happy shareholder for sure.
Thank you, Jess.
Thanks. Take care.
Okay, bye.